When you look at the concern of the banks that started in the U.S. is now infecting, of course, Swiss banking, are you confident that there's no systemic risk, that actually whatever happens, that the financial system is strong enough to withhold it?
I am pretty confident, and I think the reason for that is if you look at the differences between what's happened with some US banks, not all, of course, and what's typically the case in Europe, you see some things that are the same, but some things are very different. The one thing that's the same, of course, is that we've all dealt with a long period of very low interest rates, followed by, or accompanied by quantitative easing, and therefore a lot of cash swishing around the system, and then followed by a gradual tightening, or quite a rapid tightening of interest rates, and that's caused, some grinding of gears in the financial system. But the difference is, so that's been the same in Europe as well as in the US. The difference is that in the US, in many cases, banks seem to have invested in bonds. Loan growth was relatively robust in the US. And then what started to happen is deposits began to flow out of the banking system into money market funds and elsewhere. In Europe, we've had very low loan growth, actually. People have typically put their money in cash, not in bonds. And we haven't had the scale of deposit outflows that they've had in the United States. So European banks are typically very liquid, sitting on a lot of cash and not sitting on potential losses of holdings of long-term bonds, which is apparently what has caused the problem for SVP. So the situation is really generally very different in Europe from the United States.
But, Sir Howard, so how do you explain the Credit Suisse crisis and the fact that it has impacted all European banking stocks?
Well, I don't want to comment on the specifics of Credit Suisse. I mean, there is honor among bankers as well as among thieves. Obviously, Credit Suisse has had idiosyncratic issues, and I don't think people could sensibly read across from that one particular bank to the rest of the banking sector. So what I can tell you is overall, the European banking sector remains strongly capitalized, and it remains very liquid. And we have not seen the kind of deposit flight that is causing problems in the US. We've seen some shift from non-interest-bearing deposits to interest-bearing deposits, but typically within the banking system. So that, reduces your net interest margin a little bit, but it doesn't cause a liquidity issue.
Does it mean, though, that regulation could change even in the UK, and that if Europe is actually better protected in terms of capital, which you've explained very, very sensibly, how do these crises, though, change the European banking landscape and the UK one in coming months and years?
Well, I think it would be a false analogy to say that because of regulatory difficulties in the United States, we should tighten over here. The big thing in the United States seems to be that they exempted smaller banks from some of the regulatory requirements, notably from stress testing. That, I believe, was an error. Many people said so at the time. Over here, we have a very rigorous stress testing regimes whereby we're required to model the impact on our bank balance sheet of a significant rise in interest rates, for example, which would expose the issue that seems to have done for SVP. So I don't see why we need to change that. We need to carry on doing what we've been doing. There are in Europe as well, or the UK anyway, some increases in capital in the pipeline as a result of Basel 3.1, as we call it in the jargon. And so I think perhaps that will go ahead. But I honestly don't see that this causes us to think that we need a major review of the European banking regulatory scene, where banks are still pretty strongly capitalized. We have about 14% core tier one, and we've passed our stress tests well. So I don't honestly see what it is about this crisis that would tell us I need NatWest a different regulatory regime.
Given the speed at which central banks actually stepped in with offering either credit lines or guaranteeing deposits, is there an assumption that actually central banks will always be a backstop?
Well, some of us are a little bit nervous about the blanket deposit guarantee. I mean, this has caused now a significant unlevel playing field because, in the US, they had 250,000 guaranteed. Canada, it's $73,000 guaranteed, and in the UK, it's £100,000, and typically that's the rate in the rest of Europe. So now there is a major asymmetry with apparently US guarantees across the whole banking system, which most people would say, and certainly I would have said when I was a regulator, was generally a bad message because it removes market discipline for very large depositors. So personally, I'm not really very happy about that as a general principle, and I very much hope that we don't have to go that way in Europe.
Do you think we'll have to go that way in the UK? And of course, what you're talking about is a moral hazard. What's the longer-term effect of a possible moral hazard?
Well, I don't see that in the UK. I think it would be a panicky reaction for which I don't see a justification at this point. As I've said, we haven't seen large-scale deposit outflows from the banking system because people have had confidence in the liquidity regime, and we disclose our liquidity rates regularly, and in the capital regime, and in the stress testing regime, and of course also ultimately in the recovery and resolution regime if things get really bad. So I don't quite see why we would need to alter that regime at the moment. Now, all bets are off. Sometimes you have to recognize that sometimes situation overwhelms you and some of the principles you have to be temporarily mislaid. But at the moment, I don't think we're there.
Sir Howard, I know you worried about shadow banking when interest rates go from 1% to 5%. Is that still your main concern? And is there anything that central banks could do, slowing interest rate hikes, or regulators need to look at?
Well, I'm a bit nervous about the change in interest rate policy because, after all, the central banks are supposed primarily to deliver interest rates which will be compatible with their inflation target. And I think once you get to a position where the central banks say, well, we've kind of suspended our inflation target because we're worried about the small bank in California, I don't think that sends a particularly good message. That's likely to create more uncertainty and nervousness overall. So I'm not keen on the implications being seen to overturn monetary policy principles. I don't think that's a good way to go, actually.